Hi everyone, it's Lee and welcome to the Tesla Economist. Remember when Tesla used to have a PE of around 1000 and everyone thought it was insanely high? Well, that was an order of magnitude higher than it is today. Yes, a lot of people struggled seeing Tesla with a PE of around 1000, but not quite understanding that prior to that, the PE ratio was actually a PE of infinity, as the company didn't make any profits. And when a PE becomes positive, it has to start somewhere, even if it's above 1000. But now we're dealing with a PE of around 100 or 106 at the time I record this. Of course, we saw it a lot lower just recently on these dips. So much so, I had to make videos and explain just how ridiculous it had become and why I was buying more leaps on the dip. You see, the most popular PE ratio used is based on the last 4 quarters, or known as the trailing 12 months, or TTM for short. And over that last 12 months too, we have had some serious issues, not to mention all the supply chain issues from last year, but then the struggles with the new factories, getting them up and running, the crazy events in China, even a war broke out this year. This has by no means been a 12 months of smooth sailing where everything went to plan. In fact, it's probably been one of Tesla's more difficult years. I won't say most difficult because wow, Tesla have had some seriously hard times. It's amazing they're still standing, but I think we can attribute a very large part of that to Elon's dedication to this company and its cause. Yet nonetheless, that is what the company is being valued on, what it has achieved during more difficult times, not what it is capable of achieving when things are more normal, or even what it's currently achieving. So what if we compare the last 4 quarters production, which is what the PE ratio is based on, with Tesla's current rate of production? And Shanghai has just had a major increase in its run rate after these latest line upgrades, an increase of an estimated 40% from the Model Y and Model 3 factories. That's a massive increase in such a short period of time, and what is currently their highest yielding location, along with Tesla also increasing production at Fremont and finally getting some better production numbers for the S and X there too. Well, how about we take a look at the production levels over the last 12 months and compare it with the annual run rates we're at about now. When we look at those numbers, we can see that Tesla is at about twice the run rate from the last 4 quarters. Now I'm talking about the total deliveries over the last year, not where deliveries were just a year ago, but the deliveries that Tesla's current PE ratio is based on. Okay, I'm just using about 2,000 a week from Berlin and 1,000 for Texas. They're likely a little bit higher than that now too, but I think this is indicative enough for you to get the idea. What else has happened since the last year? Well, the average selling price in Q3 2021, which is the first quarter of the trailing 12 months, well, that was $48,800. Q2 was $55,000, except prices have risen a lot since then also, as Q2 was still delivering some vehicles that had been ordered not far off a year ago due to Tesla's long waiting lists. And if you ordered a Tesla now, the average selling price is likely even higher. Yes, there have been some cost rises, but there have also been some cost reductions on top of that. The average ASP over the last 4 quarters is around $52,000, and for people ordering today, it's likely around $57,000. Remember, these numbers do include FSD, but not regulatory credits. Anyway, that's about a 9% increase in price. Okay, some of those price rises will have to cover some additional cost. So what if we say the total cost of the vehicle has increased by 4% from inflation? Well, then that would increase margin by over 10%, from around 30% to 33.6%, a difference of 3.6% in margin, which is felt all the way to the bottom line. And with an operating margin of around 15%, then that would bring it up to 18.6%, or a 25% increase in operating profit due to the price rises. Now, yes, it would be fair to comment that Texas and Berlin have lower production numbers and haven't hit volume production, and are therefore not going to produce the same margins that Shanghai might. And yes, that is true. But equally, when they are ramped up, they're going to produce much higher margins than Shanghai with the new production techniques. And they actually are producing positive gross margins already. Alright, well we just discovered that Tesla's trailing 12-month PE ratio is based on about half the current run rate and 25% less profit of what they're producing now. So what does that mean? That means that if Tesla are producing twice as many cars with 25% higher operating margin, then they make 2.5 times as much operating profit now. Okay, there is tax involved as well before we get into earnings, which would be relatively higher with more profit, but that may only reduce it to about 2.3 times. Now, as we started this video, we talked about Tesla's PE ratio and it only being 106 at the time of this video. So if we divide 106 by 2.3, our estimated profit increases at today's current run rates and prices, at least when all the lines are operational and we're not facing temporary production stops, then we get a PE ratio of 46. So kind of like if Texas and Berlin were producing just the same sort of margins as Fremont, and production was going smoothly in China, then based on today's valuation for the company, it would have a PE ratio of 46. There are analysts out there that think Tesla should have a PE ratio of around 6, like Ford and GM. For starters, those two companies are losing market share rapidly to Tesla. Every time Tesla sells a car, it means someone else, like Ford or GM, didn't sell a car. Car sales are fairly zero-sum. Most consumers are not buying a Tesla on top of their current car. They're replacing their old car with a Tesla. So Tesla sales are growing and Tesla are getting more loyal customers and a larger market share, whilst Tesla are also raising their prices and reducing their costs, thus increasing margins, and in turn significantly increasing their profits. Not only that, Tesla are finding more ways to offer more value to their customers with the likes of insurance, a product that saves customers money and makes more profit for Tesla due to all their efficiencies, economies of scale, and technology. And this will continue, and Tesla may eventually offer vehicle to grid and end up saving you money on your monthly power bills. And then Tesla have very profitable software upgrades like FSD, then likely others to come like longer range, faster charging, or quicker acceleration. They can charge extra for all of these because there's no competition. No one else is able to compete with these specifications at these price points. So Tesla has the market to themselves due to massive technological advances. With those features alone, I would give Tesla a PE ratio of 30 if it was fully matured and robotaxis and future FSD advances were not included in the model. As in, if Tesla are at about 20 million units a year and we're not looking at expanding any further than that. But I think the majority of us think that Tesla will not stop at 20 million a year, especially if the Model Y could end up selling 5 to 10 million a year alone. What happens when we have a van, coupe, compact, SUV, and the whole range of vehicles like Elon says? So a PE ratio of 30 is what I would give Tesla if fully mature, or perhaps closer to 25 now in this market environment, which won't last forever. Yet we're at a PE of 46, with a run rate 1/10 that level. And like I said, this is keeping robotaxis out of the model. Oh, and energy and bots, and all other future products Tesla will produce to make the world better. So when Tesla are currently at a kind of real-time PE ratio of 46, sure, with a little reaching there with Texas and Berlin margins, I can admit that, then I think that a PE based on the last 12 months of performance at only 106 is too low. Or in other words, I think Tesla's valuation still feels low to me. But we just did this based on where we think Tesla are at now. How about we review this again on where Tesla will be when these new factories are ramped up and this new Shanghai expansion is also added? I wonder what it comes to then. Thanks for listening. Please hit the thumbs up and subscribe. You can follow me on Twitter and talk to me on Patreon.